Along with my day job running an investment business, I started Tinsley Park Talks, a global networking and leadership platform where I interview industry legends from finance to tech and great thinkers to notable celebrities. In these interviews, we discuss great ideas around investing, entrepreneurship, problem solving, and all other lessons of life. Welcome to another episode of Tinsley Park Talks. Hey guys, welcome to another episode of Tinsley Park Talks. If you enjoyed this video, make sure to give it a like and subscribe to our channel. Thank you. This program is in partnership with Nesh. For more information, please click on the link below. Ali Hamed is the co-founder at Coventure, where he's redefining private credit and venture capital investing by combining these strategies together. Whether you call it esoteric finance or cutting-edge investing, Ali has been able to scale Coventure from a startup fund to over $2 billion in assets in just a few short years. Join us on a great conversation with Ali on his journey leading to Coventure and how he's driving his vision forward. Welcome to the show. How you doing, man?
I'm doing very well. Thank you so much for having me.
Yeah, it's such a pleasure. You're all over the internet and the investment world now. They know who you are. You're on Patrick Shaughnessy's podcast, and everybody else wants you to be on. Man, I feel really lucky that you joined. Thank you.
Yeah, thanks for having me. I'm still surprised that people keep having me on. It's one of those accidents that happen, but I'm having fun.
Happy accidents. Who says that
Happy
again?
accidents.
Yeah, like that painter guy. Remind me, like on PBS. I don't remember his name right now.
I think happy accidents happen more in equity and less in credit.
Yeah. Well, listen, I'm really excited about today's conversation. Obviously know you for almost a couple of years now in your firm. We work with you guys together on an investment. But today
I think it's going well, right?
They're doing well. Very, fingers crossed. Hopefully.
Are you a happy co-investor? How have we been?
Would I be talking to you? Actually, even if I was not happy, I would bring you on and we'll still talk about it, because you got to talk about the good times and the bad times, right? But these guys have done really well in good times, but we'll come back to it later. I want to start with your story. So this is about you today, Ali. So Ali, I want to, like I start most of my podcasts asking about the beginnings, right? I know you're originally from SoCal, but tell our viewers your upbringing and days leading to New York City.
So I grew up mostly in Southern California in a town called Agora Hills. And, it was a town that had really good baseball and I wanted to fit in. And so I got, really excited about playing and had the opportunity to go Agora to Cornell, where I played there for a bit. And I grew up as an only child. I went to an event recently where they did a survey of like what percentage of the founders there were either oldest or only, and it was like a shocking number of people were eldest or only children, which I thought was sort of interesting. We moved a bit growing up. At one point I was born in Pasadena, then we lived in Florida for a little bit. I did elementary school in Connecticut, and then most of my childhood was really California. But I think being the new kid at school, was useful. It made it a little harder while in school, but was sort of useful in learning how to meet people and kind of like create some need to fit in and kind of nudge my way into groups. And so, my professional life, that's been helpful. And then, I had like incredible parents. I'm incredibly, I think I'm as close to my parents as basically anybody could be. And, I had the gift and the curse that they told me I could be anything. And as an only child, I actually believed them. And, it probably gave me some level of overconfidence and maybe still does sometimes. But, I'm really grateful for it. And I think if they hadn't given me that encouragement, I probably wouldn't be an entrepreneur. So, I guess that was like the four corners of my childhood.
Where are you originally from? Or your parents? You're born in California, right? Just curious, where are your parents originally from?
Yeah. So, my mom was born in Southern California and my dad was born in Libya. And so I'm half Jewish, half Muslim, which, like everybody else, I'm sure it's a pretty, thin Venn diagram. And it was really cool to kind of grow up that way. And my parents met at UCLA and, have been married and happy ever since.
That's cool. So where did you play baseball? Was it high school or did you play some in college?
Yeah, so I played at a high school called Agora High School. And it was a competitive and fun program. And then I ended up playing at Cornell, and I played right field because I was a lefty and I was short, and I had a good arm. So I played right field.
So why'd you stop playing baseball?
The main reason is I had done a startup, and I realized that I was probably better and had more potential as an entrepreneur than I had as a baseball player. In baseball, I worked really, really hard, but my abilities were basically like I kind of probably stretched my physical capabilities as far as I was going to be able to. And it was more just because I worked really hard than anything else. And I saw other people play and they looked really, really good and I looked okay. Um, and then I started doing startup stuff and I felt like I was naturally better at it. Like I found that a lot of things came easier to me than they came to other people in the same way that I think I wish that had happened in baseball. And when I realized that, I had an opportunity to probably be, you know, in that top kind of small group of people doing what I was doing in the startup world. And then I looked at baseball and I was like a top quartile person at best. I just realized that I was better at one than the other. And I fell in love with startups and, I fell in love with founding a business or at least trying to found a business when I was in college. And I found a history of it really fascinating. And it just like, it became the thing that I couldn't stop thinking about. I remember we were traveling as a team for a tournament. And everybody else would be out hanging out or in the rooms hanging out, and I'd be downstairs like teaching myself how to code and just really loving it. By the way, I was terrible at it, but I loved it. And I just realized that maybe that's what I should be doing if it was what I was doing with my spare time anyway.
Got it. What's funny? One other guest that I've had, and you might know this person. His name is David Rubenstein. He also played baseball in his young years. Okay. And
This might be the first time David Rubenstein and I have been mentioned in the same sentence. So I feel
really?
badly for him and fortunate for myself.
I'm gonna mention him again later on, but let's talk about your leap into entrepreneurship. So as I understand it, while you're at Cornell, you already started doing consulting projects. Tell us about that and tell us how that led into your interest in investing and early days to starting Coventure.
Yeah. So, I really wanted to be in venture capital, and it's really hard to meet people in venture capital, especially when you're not already in it. And I wanted to build a network for myself, which is really challenging, not only when you're an undergrad, but especially when you're in an undergrad in a town like Ithaca. And I loved my Cornell experience. I think if I hadn't gone to Cornell, it'd be very unlikely that I'd be doing what I'm doing now. Because the alumni have supported me so much and my professors supported me so much and I learned so much there and the friends that I made there have gone on and done really incredible things. So I feel like I just got so much from the place, but it is in Ithaca and it's very hard to build a network. And, and also VCs are busy and they have a lot of, I have undergrads who email me all the time and I wish I could have an opportunity to talk to every single one who did, but time's scarce. So, I think it was like my sophomore year or my junior year, there was a class on how to use Microsoft Suite. And me and a bunch of other people who were in this thing called DSP, we all learned how to use it. And we thought we were a bunch of bankers and all of our friends were doing their banking internships. So we thought we were a bunch of hot shots. And what we did is we would go around basically building these PowerPoints. And I did this primarily with a guy named Brian Harwitt, who actually I still work with, and he's one of our partners now. And we would do these PowerPoints that you can still find on SlideShare, because that was like a popular website at the time. That would basically just break down industries. And, we do elderly care, we do marketplace infrastructure. At one point, we thought we were so big time because we got a small VC fund to sponsor one of our research reports and put their logo on the front of it. And we thought, well, gosh, we're getting paid now.
That's pretty cool.
We're the real deal. And, and so what we would do is we would cold email the corp dev offices of a lot of companies in those spaces. And we would ask them to help us with a research report. And then what we'd do is we'd cold email a bunch of VCs. And so we would just guess at their email addresses if they weren't online, like first name at domain, first syllable, last name at domain, first name dot last name, like whatever it was. And we'd email them and say, hey, I'm putting together this PowerPoint. It's a research report on an industry that you invest in. There's 2 or 3 companies in your portfolio that actually made it into the report. We'd love to talk to you for 10 minutes to understand what we got wrong. And I thought that was a really compelling email because it wasn't like, how do I get a job in venture capital? because it's such a hard email to respond to because it's such a long answer and it's so nonlinear and there's not an obvious way to do it. Um, and so, we thought, well, gosh, like that would be a way to get these people on the phone. And then when we got on the phone with them, we said, oh, by the way, I have like 3 or 4 companies that may want to buy one of your portfolio companies. And it was cool because these people were sort of blown away. It was like they were talking to this junior in college who was helping them get one of their companies acquired. And so they started.
Sorry to interrupt you. I was just curious, like as a junior in college, how did you know, to call the corp dev people? How did you know who to cold call? Like, just curious.
I mean, everything was online. People would blog and you'd read the blogs or you'd read books like Venture Deals or you'd read books like Founders at Work. And, I'd read every autobiography that anybody who worked in finance, had put out. And then probably Cornell, there were a lot of students who, I remember there's a kid named John Yoshida, who's now an investor at Hellman Freeman. And he was like one of the smartest kids that I'd ever met. And I asked him what he wanted to do. What was his dream job? And at the time it was like work at Google Capital. And I was like, well, what's Google Capital? It's the corp dev arm of Google. And they did all the cool, and like, I was like, oh gosh, that sounds amazing. So then I thought corp dev was really cool and I wanted to meet all the good corp dev offices. So, I think a lot of it was just talking to the kids who are seniors who ended up going on to do really amazing things. And I just got lucky that I was surrounded by good people who gave me small tidbits and I ran with them. But anyway, so what I would do is I'd get to know all these different venture investors. They were friendly because I wasn't asking for anything. Actually, I was offering them something. And then after I get to know like 5 or 6 VCs in a specific space, I would introduce them to each other and say, hey, the 3 of us should go get drinks. And they really didn't want to spend any time with me, but I was like the person they had to hang out with to go hang out with the other person. And so I'd put people together. And I realized that I really needed to make sure that the average person who I met would introduce me to over 1 person. That doesn't mean that like each person would introduce me to more than 1. I just needed the average. So someone introduced me like 10. It was amazing. And the reason I thought that is like I needed to build a viral loop, like a social network, because that's for myself. And so what I would also do is once I felt like I'd impressed somebody enough where they would take my next call, I would go through their LinkedIn and I'd go 10 names at a time because you can't download somebody's network all at once. And I would basically just write down everybody on their in their network that I wanted to meet. And I would say, hey, wouldn't you know it? I actually just like did an analysis on all your whole network. And these are the people that I think that are the most impressive. And, here's 5 in particular that I'd like to meet. And I've sent you 5 individual emails that are all forwardable for that specific person. And the reason I did that is if I like pinged you and I said, hey, Najib, like it would be amazing if you could introduce me to some investor friends of yours. 1, you would be like, oh my gosh, I'm asking for a favor. Now I'm making you type a bunch of emails. 2, you wouldn't introduce me to the best people. You'd introduce me to the people that like were easiest for you to make an intro to. They owed you a favor, or like they were your friend, or they were like not that important. So like it wouldn't matter if they were kind of annoyed at you or for making the intro. But instead, if I said, hey, here's a person that I want to meet, and I put it in the head, like the subject line, I said, hey, if you don't mind, what you're then doing is you're just forwarding it. You're just the messenger. You're not like volunteering their time. Also, the person on the other side of it is a lot more likely to respond because they're like, crap, like he knows that if I say no, I said no. Whereas if I just sent a generic email, they could feel like they were saying no anonymously. And they would be annoyed at you for volunteering their name into the pool because now they have to say no to you. And I would just write these forwardable emails. I always joke that 3 available times and forwardable emails are like the 2 superpowers in finance. And I just did that until I met a lot of people. And, and I would, try to prove to people that I could do good work, and I'd do these random consulting jobs for them. And a lot of people needed to build web applications or iOS applications. And so I'd, land the work and I'd manage the projects and I'd help deliver that to them to make myself credible and give myself a little bit of money where I can make a few investments. And that was really how I kind of built my initial network and kind of got into the venture ecosystem. I just sort of worked my way in name by name.
That's awesome. Can you share some of those little investments you made with the money that you made then? And were these, what kind of check sizes were you writing? And if there is any kind of a connection to how those investments led to you starting Coventure, that would be interesting to know as well.
Yeah, I mean, they were tiny. And what we realized in Nesh after like trying to make a few or doing a few, like $10,000, $25,000 is nobody was going to take us seriously and we needed edge. And the first idea was like kind of a crummy idea, although we made the most of it. we would go to a bunch of non-technical founders and say, hey, you want to build something, how about we build it for you in exchange for like a couple percentage points of your company. It was actually inspired by Wilson Sonsini and Cooley and stuff, which were law firms that would essentially say, hey, you can't afford the $20,000 to form your business and do your initial term sheet and all that. So we'll defer our payment in exchange for a couple points of your business. I thought, well, gosh, why don't we just do that with web development or application development? And we would work with these non-technical founders who, even though they were non-technical, they knew their industry really well. And so, the first company that we actually did that with was a business called Produce Pay that really did have a lot to do with how we started our business. And, for Produce Pay, they were a business founded by a guy named Pablo Borquez. And Pablo came from a fourth generation farming family out of Obregón, Mexico. And he realized that a lot of farmers lacked cash flow during the harvest. And they really didn't have a lot of liquidity because they were relying on their distributors, or what they would call marketers, to give them liquidity during the harvest. And it was sort of a challenging experience for them because, they couldn't get as much money as they wanted. The distributors and the marketers would sometimes run out of money and not be able to finance all their farmers. There was very little visibility on when the money would arrive, how much would arrive. You were sort of tethered to the distributor that you were working with if they were the one offering you financing. And so we ended up building this business where we would basically build inventory technology to track the produce in real time. Technology is really good at unearthing new types of credit, especially when those loans are short duration, because you can't underwrite a 2-week loan by hand. You just don't make enough revenue on it. But you could underwrite a 2-week loan or financing or asset with technology. And, because of that inventory technology really turned into a financing business. And then he needed financing. And so we introduced him to a family office. And midway through the deal, the family office kind of retraded them on the term sheet, dramatically. And we had also introduced them to a firm called Social Leverage, which is run by Howard Lindzen, and another firm called Arena, which is run by Paige Craig and Jeff Lowe. And they were going to do the equity round on the condition that debt financing was lined up. And when this family office started retrading them, we thought, holy crap, there's like a non-compete. They can't disclose the terms to anybody, but like, we're insiders. We already know what's going on. They can't solicit to us, but we can make them an offer and see if they'll take it. And it ended up happening actually after the non-compete was up in the end anyway, so it didn't really matter, but we were able to be prepared to make the offer. And that's how we saved the equity round. And it was also a way for us to generate cash flows because they had this amazing credit. And actually, it's, the first time we ever financed Produce Pay was May 29th, 2015. And we're approaching 10 years in the business and we still fund them. Oh, wow. Yeah, it was an SPV really that helped keep their equity round alive. And then we thought the credit was really good. We ended up having more people interested in giving us money for that than a venture capital fund. The feedback loops were a lot faster because the financings they were doing were like 30 to 45 days in duration. So you could start to get cohorts back quickly and start building data really quickly, which you can't do in venture capital. And next thing we knew, we were credit investors, not venture capitalists. Right. And that was sort of the very, very beginnings of our credit business.
That is really cool. Obviously, today we wanted to talk about this unique strategy that you guys, well, for the most part, like, I don't know any other funds right now that are doing VC and credit. So would love to kind of understand how that firm's been shaped so far. So why don't you tell us the birth of Coventure and Crossbeam and what they are today?
Coventure really started off as that SPV. And when we did that deal, I remember having to work so hard to meet all these different people in venture because, like, do they really need to know one more knucklehead who's going to build software for equity in their business or write a tiny little angel investment check? Not really. And they would talk to me because I worked really hard and I was, enthusiastic or whatever, and they were kind. But we did this debt financing, and all of a sudden, all these people that I had been trying to get to know for a long time wanted to get to know me. And it was incredible. All these people I'd always wanted to meet. And I was talking to partners at VC funds every day. It was as a 24-year-old, it was the coolest thing. And so we thought, well, gosh, maybe that's the thing that has product market fit. And so we started setting up these SPVs because we couldn't raise a fund. We didn't really have a track record or anything. And luckily, some of the people who had done the Produce Pay SPV we had raised thought, well, hey, it would be great if we could find a bunch more of these. So they decided to give us equity capital into our holding company. And that was primarily led by a guy named Mark Spilker, and Mark had been the president of Apollo, and before that had been a really senior guy at Goldman, and today has become just like this amazing influence on my life and friend and mentor. And so he led our financing to give us equity capital. We used that equity capital to go hire a number of people, and who were professional investors, and we were a fundless sponsor. And we got a ton of deal flow because there weren't really any people offering asset-backed credit to tech companies. There was lots and lots of venture debt. And for the longest time, people used to call us venture debt. It just drove us nuts. Venture debt is basically lending to a startup company, making a corporate loan, where if the company goes bankrupt, you probably lose your money. If the company does well, you make money via interest and warrants. And largely, venture debt isn't really underwriting the company. I mean, they do a little bit, but what they're really underwriting is the equity sponsor, the VC fund that backed them, and the likelihood that that sponsor is going to keep funding the company. And we don't like that. We feel like it's underwriting future capital markets, not cash flows or anything that we think has real credit behind it. Instead, what we were doing is asset-backed credit. So we were offering asset-backed loan facilities or asset-backed lending facilities to companies where they would run around. They'd have a need for capital that wasn't their operating cash or payroll or anything. What they were doing is they were raising money from us and then using that money to either make a loan, finance an asset, buy a cash flowing asset or something similar. And then they would take those assets and they put them in an off balance sheet SPV, and we would lend to that SPV. That was bankruptcy remote from the actual startup company. And we were really one of the only people doing it. I mean, Victory Park helped invent the space, and they did that a lot with consumer loans and small business loans, and more recently have done more novel stuff. And we have a ton of respect for them. We're actually very grateful to them for having done what they did, because it helped kind of blaze a trail. But there really weren't many. And so we were unique. We had a point of view also that, asset-backed credit really hadn't been available to limited partners in a long time. And the reason was, unlike in corporate lending, most things, and even in corporate lending, most things in credit can be rated. And as soon as they're rated, the people who really finance those things are insurance companies and banks who have really, really cheap cost of capital, which you can talk about why in a little bit later. And so an LP, an individual, an institution, anybody trying to get high returns really couldn't get high returns in credit because the rating agencies had made these things so available to regulated institutions that had no cost of funds. But if we found these tech companies that were originating new forms of credit and new types of assets that couldn't be rated, not because they were riskier, but just because they had some sort of quirk to them, or they were funkier, or they didn't conform to being a normal consumer receivable or something like that, we could get a really high return relative to the risk that we thought we were taking. And so that's what we did. And we always joke that people gave us money despite our backgrounds, not because of our backgrounds. I mean, think about how compelling the opportunity had to be for people to give credit LP dollars to like a 25 and 26-year-old. But we were able to do it. And then after raising a number of SPVs and generating a ton of deal flow and feeling like we really carved a part of the market for ourselves, that we were really either the only or one of the only players in 2019, we went to all of our SPV investors and we offered them a fee discount if they collapsed their LP interest into a fund. And, and then that's what we did is, that's how we became a business that had discretionary capital. So that was sort of the beginning of the Coventure credit business, asset-backed credit. Along the way, we've been making angel investments and making equity investments in companies to SPVs. A lot of our LPs are general partners at VC funds, general partners at private equity funds, hedge funds, places that they would find a lot of access to deals. A ton of our LPs are founders. So I'd say almost all of our capital on a dollar-weighted basis is institutional. But if you look line by line, there's a lot of individuals invested with us who are really connected. We can't talk about them much because they run their own funds, and we try to keep people private, but it's a really incredible group. And because of that, we were seeing a lot of startups. And as you'll remember, the first love that I had in college was startups, and wanting to become a venture capitalist. And I finally did have credibility, and I finally did know people who could give us capital. And, I think when people launch a venture capital fund, you can either do it because you have a really good track record, or people who will give you money, or because you have a really good story. And we really didn't want to have a really good story. I think a lot of people make up a fake story because it's good for marketing and they need somebody to be able to tell another story at IC. And if you think about the best VC funds, a lot of them don't really have a story. They're generalist funds. I mean, the firms that we look up to, Benchmark, First Round, SoftTech now Uncorked, Felicis, a lot of the great seed funds, they're just generalist funds. And we can talk about why that is in a moment, but we really didn't want to make something up. So we used the track record from our angel investments and our SPV investments. We used relationships that we had built over a number of years. I mean, raising LP capital is a lot like it's a 2 to 4 year sales cycle. When people say, well, I want to start an investment firm, do you think I should do it? I ask them, well, who's going to give you the money? And if you don't already know who in your life likes you enough and trusts you enough and has the capacity to do so to give you capital, you're 2 to 3 years away. And I had the access to capital, and so we raised capital for a venture capital business, and then we spun it off into a new business called Crossbeam. And the reason we called it something different is that other than Ribbit and Google Ventures, or sorry, not Ribbit, excuse me, Bessemer Venture Partners and Google Ventures, very, very few have ever been associated with another and then spun off and done incredibly well. And we didn't want people to get the impression that our venture capital business was going to be strategic to the credit business or focused on lending companies or focused on fintech or anything. We wanted to give it an ability to be its own business, and that's what we did. So it became Crossbeam. The third business that we launched is Hybrid Capital Solutions, and that sits within Coventure. That's part of our credit business. And there, what we do is we find founder-owned companies usually, although we're not offended by a company having venture capital dollars or being sponsor backed, but on average, they're founder-owned. And they can't agree with the market on price, so they have some complexity where people have a really hard time pricing them. And we're usually able to give them an offering that has the downside protection of credit. We're underwriting them to a debt to EBITDA multiple, or we're underwriting the assets that we're financing against. But through some combination of current pay, PIK interest, contractual returns, warrants, participating preferred securities or something, we're able to get what we think are closer to growth equity like returns. So those are the three businesses we're in and kind of how the business got formed.
Interesting. As far as sector focus, why did you start with fintech, and what was so interesting also about the creator economy that you saw, where this investing model seemed to have worked?
So with fintech, the angle was largely capital markets and credit. And, I always thought credit was really interesting. I read the book Lords of Finance when I was probably too young, but and it's a terribly named book because it sounds so lame. But basically, it was sort of the story of the forming of central banks between World War I and World War II, and when there was war reparations between Germany and France, and Germany really and the rest of the world, France wanted to forgive the loan to Germany. The UK wanted to forgive the loan to France. The US wasn't willing to forgive the loan to the UK because the US had sort of just built up its banking system and its federal, its central bank. It wanted to demonstrate to the world that if people owed us money, we would go get the money back. And because of that, there wasn't the euro or anything. Germany saw the franc, and so they had to print money because a sovereign can't really go bankrupt if you can print your own currency. But the equivalent of going bankrupt is you print money. And then there was hyperinflation, which caused instability. And, whatever, I don't need to finish the rest of the story, but I'm sure that had, something to do with what happened next. And I was just blown away. I was like, oh my God, this credit stuff is really serious. And, I'm half Muslim, in Islamic law, you can't lend. And I was like, well, gosh, clearly there's something really powerful about credit. I mean, Jesus.
Well, Christians couldn't lend for a long time too because of the usury laws. And then the Medicis figured out a way to call it commissions, and it was just one of those.
Oh, and everyone's gotten away with lending in some way. There's there's ways. Literally one of the ways that people will lend is they'll make a 0%. In certain religions, it's not about lending; it's actually charging interest. So they'll make 0% interest rate loans and then sell you an insurance product with an insurance premium equal to the interest they would otherwise pay, where the claim is if you default. I mean, it's the craziest thing. Whatever.
Creative structure.
Point is markets are efficient, but it got me really it gave me a lot of respect for credit. It made me think, well, this is really a big engine of how the world works. It felt important. And investing at scale felt important because, investing is a really good way to kind of express your point of view on the world. It's a way to open up markets. I'm really proud that, we finance some billions of dollars of produce that comes to the United States, and however many people in these farms in Latin America get to work because we made a decision to lend there. Or fund there. There's a lot of analogies to that across the portfolio. And so it was a way to invest at scale. It felt important. It felt like it was important to be a responsible actor. And I just fell in love with the credit business for whatever reason, which I know is an oxymoron because nobody loves credit, but I loved it. Um, and I felt like it was meaningful. So that was how we got into fintech. And because we did that, we had a point of view. We knew a ton of people in financial services. We also felt like we uniquely understood why some financing businesses were valuable and others weren't, whereas most people in the venture capital community couldn't figure that out. So we had edge. The creator economy was, I mean, different and maybe a little bit less long-winded. It's called Spotter, and
Yep.
Spotter funds YouTube catalogs. I mean, what they do is they basically go out to a bunch of YouTubers who are prominent, and they offer them liquidity and capital really by financing their back catalogs. And we understood that business because we thought of it a lot like music royalties. Well, we thought, well, gosh, these are like media assets with a declining decay curve of revenues. You could underwrite that decay curve and you could finance them at some reasonable price. We love new asset classes. They had a big data moat that had, a million people have tried to compete with them. Nobody can. I can't tell you how much money has been lost with people trying to compete with spotters. Awesome to watch. It's awesome to watch your competitors lose. And we had real edge there. It was an incredibly happy investment for us. And so we were able to use the learnings from that business to really understand what was going on in the creator economy. The other insight we had was that social media was no longer social. And we were watching social media and everything there was like professional media creators. And for a long time, VCs in particular were obsessed with network effects. And if you really just assume that network effects were built on peer-to-peer networking, but you no longer had social contributions into the content that was being provided, network effects were going away as social media was no longer social. And as network effects were going away, these platforms that were monopolies were really losing their leverage over the constituents on their platforms. And as they were losing their leverage, more of the value was going to go to the people on the platforms. And so we used to call the thesis social media is not social and emerging forms of media. We did incredibly well, in our opinions, in that space. And then a bunch of these frickin' knuckleheads all called it the creator economy and it had so much ring to it that everybody started investing and it became impossible to make money. So luckily, we got our bets in early. We've done incredibly well. We're very happy about it. But by the time there's a name for what we're doing, we probably don't want to be in the space anymore.
Got it. Ali, how do you diligent these? Did I say that right? Is diligent the verb?
Diligence.
Yeah, I knew there was something wrong there. Use a noun for instead of using a verb. How do you diligence a credit and a venture deal if you're doing both at the same time?
Independently. If there is an event that we're in both of a company, we had to be really careful of it because you wouldn't want to be overly kind to your credit, to your equity investment because you're trying to save your equity when really a company's in default and vice versa. And so we have completely separate investment teams. In the event, I would be the only overlapping member of the ICs and I just recuse myself in those situations. And it's a whole thing that we've had to create of having policies where the decisions really have to be made separately. From time to time, there's information and thesis development that we can help each other with. But the people on the investment teams have to get paid differently. They have to get paid from different pockets, and they have to get paid for different reasons. Otherwise, you could be unfair to your LPs who are in one fund but not the other. But I guess broadly, your question was, what's the difference between equity underwriting and debt underwriting? And they're very different. In credit underwriting, you're like a professional penalty kicker. Every once in a while you score and nobody cares. And then if you miss, everybody cares a lot. And so your life has to be about making sure that you're never going to lose the money. And also, people invest for different reasons. When they give money to a credit fund, they're giving you money they can't lose, and they're giving you money for their retirement, their savings, a pension, a 401k. I mean, it's a stressful way to live because there's a responsibility to that meaning that I get from credit that I really, on some ways, is one of the reasons I'm so stressed and I take my job so seriously. On the other hand, gosh, what a privilege that people really trust us that much. And because of that, you have to underwrite to make sure that you don't lose money. I think when credit investors get things wrong, they sometimes over underwrite the security. and don't spend enough time underwriting the company itself or the asset itself. And when equity investors get something wrong, they're like so focused on like how the company can grow, and they don't underwrite like the structure of what they're investing in and if their security aligns with the founder. With credit, pretty quickly want to understand where the edge is, especially in asset-backed credit, around, are you sourcing differently? Are you underwriting differently? Are you servicing the debt differently? Or are you sourcing capital differently? If you're sourcing capital differently, we don't want to be a part of it because we're the capital. We don't want to be disrupted. And you need an edge in one of the other three, because if you don't have a competitive edge, then you're just selling money next to everybody else who's selling money, and that's a commodity. So if you're getting paid more than you think you should, either that's going to go away or you're wrong. If you have a competitive edge, that's really great. In the case of Spotter, they have historical data from YouTube creators and viewership and decay curve that nobody has. They have a data set that nobody has. In the case of Produce Pay, they have an origination and information advantage. So you have to kind of keep figuring out the company and what their edge is. And then once you know their edge, what you usually do is you run through like a series of cash flows from the underlying assets that they've historically financed, and you look at them. And then what you try to do is you try to structure a loan such that even if things got 2, 3, 4, 5, or 6 times worse, you would still get all your interest back. And in the structuring, you also want to have covenants in the deal where you could catch things before they start to get close to where you lose your interest, and you could default. And then if you defaulted, you want to underwrite, can I get the money back? Like if I lend money to some consumer in, a continent that I don't live in, am I really going to fly over, spend, thousands of dollars on a plane ticket to go collect on a $2,000 loan? No. So that would be like, can I actually service the asset? And sometimes if you don't have a lot of data, you have to say, well, what is this asset very similar to, and what is my comp? Even if you do have a lot of data, you have to say, well, if this feels like a consumer loan, for example, and consumer loans, let's just say, default at like a 2% loss rate per annum, but this one's defaulting at a 7% loss rate, your question is like, why is this so different? Why is this so much worse than the comp? What you're also looking for is like the story and the data to add up. And so that we're underwriting too. And you want, and hopefully it's like better, but not like crazy better than what you were expecting. And also the more data there is, the less of a loss coverage ratio you need, the shorter duration that the assets are, the quicker you can decide how confident you are. And then structuring is a huge component of it. Structuring is a part of credit that matters so much more than it does potentially in equity investing. And when you're doing an asset-backed credit deal, I mean, there's a lot of work. Like our loan packages, when we get the closing package at the end, might be hundreds of pages. There's the loan service agreement. There's the purchase and sale agreement between the corporate and the SPV that you're financing. There's the legal opinions, the subordination agreements, across default provisions. I mean, there's a lot of stuff. And when I started first reading these documents, I was lucky that we worked with good attorneys, and I was lucky that we hired people who knew what they were doing. But I would just ask myself all the basic questions. I would ask myself, well, who did we lend to? How much should we give them? What happens if we don't give them the money? How much do they owe us back? What happens if they don't give it back? When do they owe it back? Do we have to give them more? Can we give them more if we want to? What happens to the management? Like I'd ask myself all the basic questions of the deals. And I'd read these documents and I'd just highlight in yellow all the answers to my questions. And then I'd look at the document and I'd see what wasn't in yellow yet. And I'd say, well, gosh, what does this mean? And then I had an Excel sheet that I literally would write down every term I'd ever seen in any loan agreement ever. And then when I got a new deal, the easy part was to edit what was already there. The hardest parts are to think of the things that never made it into the document in the first place. So I had this baseline checklist that I would keep adding to with every deal that I ever did. And that was really how I learned also the structuring part. And so, I would say in credit, you're trying to find the edge. In sourcing, underwriting, servicing, or capital, you're trying to take a data set, underwrite to a loss coverage ratio based on historical data, figure out what your confidence is based on how much data there is, how granular it is, and how short duration the asset cycles are. And then you're trying to build a structure that can withstand the underwrite that you did to make sure that you could kind of get to some level of protection. So that's credit.
How do you think about future milestones of a portfolio company that you've invested in, and whether or not they graduate to a different credit facility with a lower cost of capital, which I would imagine a lot of these companies that are coming to you for the credit solution, it's great because they're not getting it anywhere else, and you've created almost a new asset class in this regard. But how do you think about those follow-on rounds?
Mm-hmm. So that's where it kind of becomes a little bit more like the equity investing framework, because then what you do is you build this memo in credit when you do the deal, and you're asking yourself, like, what do I need to believe? And the reason you want to know what you want to believe is what are the reasons you're either going to loosen the terms of the document, add more capital to the position, or potentially lower your interest rate. And you would loosen the document. Well, I'll give you an example. Let's imagine there's a new like pool of assets, and we think the thing's going to default at 2% per annum, but it's still a new deal, and we're not really that confident. So we might make sure that we're structured where we could withstand like 20% default rates, not because we think it's going to be 20%, but because we just don't think we know. And so, there's $100 worth of assets, and we're only lending $60 against them, so that no matter what happens, or I guess that doesn't really work. I guess it would be like 80, But we've come up with some advanced rate where we could build like a 10 times loss coverage ratio. And what we tell the founder is programmatically in the document, we will unlock more and more capital and increase your advance rate as the default rate proves out and actually ends up being a 2%, or actually ends up being below 3.5%, or whatever it might be. And so we're asking ourselves, like, what do we need to believe? And in credit, the way to hit a home run is not that you earned like a 13% when you were hoping for a 12%. The way we hit a home run is we find a deal with tons of alpha, and then we can scale that deal to be hundreds and hundreds of millions of dollars, so we can generate millions and millions and millions of dollars of alpha for our investors. It kind of sucks to do a $10 million deal where you're only 100 basis points out of market because you made $100,000 of alpha for people. What you're really trying to do is scale into a position. In venture, I think there's a lot of parallels, because a lot of it's the what do you have to believe. The other thing that venture teaches us about credit is less about the structure and it's less about the diligence. It's more about, is this thing going to originate? The other thing that you're looking for in credit when you're deciding if you're going to expand is like, are they actually able to make loans or able to finance new assets? Is the way they're doing it competitive, where they're going to have a barrier to entry and be able to keep doing it? Is the TAM big enough? And is it providing value to a customer? If a customer is paying 15% for the money, but they're using that money to generate a 12% return, you're not going to be able to keep making loans. And that very like bottoms up way of thinking about underwriting, I think, has actually informed a lot of our equity business. I think the reason that our equity business has been able to have such a high hit rate is because, we ask ourselves pretty basic questions. We ask ourselves, what are the 15 to 20 things that we need to believe for this company to work? We then ask ourselves, will we be qualified to figure those things out? And the third question we ask ourselves is, would it be a good use of our time? And, usually if it's a company that it's so unlikely that those 15 to 20 things are going to check out, it's not going to be a good use of our time. Or if it's in a space that we don't know, it's probably not going to be a good use of our time. And then we just go into a company and we ask ourselves, like, is management going to be good? Is the TAM there? Do they have a competitive edge of how they're going to go to market? Do we think people are going to use this thing? Why do we think people are going to use this thing? How sure are we that they're going to use this thing? Is it going to add value to them? What KPIs are we looking for to try user metrics to see if, like we're looking at a deal now that's it's a re-up. It's top of mind because it was literally the conversation I had before this podcast. Company's growing, but the company isn't growing as fast as we expected them to, because they claim that they're firing clients. They're claiming their high quality revenue is growing, but their low quality revenue they're getting rid of. And we said, great, let's go into the cohorts. Like, let's actually look to see if their low quality revenue, as they would say it, was using the product a lot, or if it wasn't using the product a lot, maybe they were the ones getting fired, not the other way around. And how are they judging high quality revenue? Is it actually adding value to the customer? And those underwrites that we do on the equity side to decide, is this thing actually going to grow or not, is a lot of what we end up doing on credit if we're deciding if we want to upsize the facility or not.
Got it. I want to take a little zoom out here on the macro situation.
I'm a bit of an in the weeds guy, if you can't tell.
You are. You are. I mean, if you're doing credit, you have to be, right?
I don't know another way to do it.
I wanted to ask you about this, just the rise in private credit recently, right? We've seen the asset class grew from 250 billion in 2010 to 1.5 trillion, in just within 15 years. How does that affect your business?
Most of that rise has been in corporate direct lending, and it's been in rated assets. we haven't really seen a whole lot of it affect our business much, other than going into private credit is like now cool, so we can go get better talent. When you think about what people talk about when they say private credit, what they really mean is either sponsor-backed direct lending or non-sponsor-backed direct lending. And that's usually making a corporate loan to a company that's owned by a private equity business, and they're underwriting it to some debt to EBITDA ratio. And the people who do that are largely BDCs who have a turn of leverage on them to get themselves to, a low double-digit return. And those deals are usually getting printed at like SOFR plus 650 or something. And with like closing fees and origination fees and all that stuff, maybe a little bit higher. And, if you thought about why that asset class should get bigger, if a company is being bought at 8 times and with the all-in debt, the senior tranche usually being at like 3.5 to 4 times debt to EBITDA, you're probably around there. Who knows what the EBITDA actually is, but let's just pretend that it's real. And then you have some mezz finance in another turn that can get you up to 5 or 6. And there's metrics in any survey that you read that'll convince you that it's sometimes higher, and maybe it is. A majority of these transactions are being done with debt. And so it makes a lot of sense that asset class is really big, even bigger than private equity, and private equity is bigger than anyone thought it was going to be. And so if you think about any of these big asset management firms, whether it's Carlyle or Apollo or Blackstone, a lot of their capital, maybe even most of their capital, has really become debt capital. The other motivator for them is, doing lending deals is good for the equity value of those businesses. Because Apollo and, I guess formerly Fortress and Carlyle, they're all public companies. And if you think about how these public companies get valued, they're usually on what's called FRE multiples, fee-related earnings. And you don't really earn a high multiple on carry that you get from private equity, because public market investors have a very difficult time understanding how that should be valued. I think when TPG went public, I think they stripped their carry out, actually, of the filing, so that the partners kept their carry and the public market didn't get exposure to it. Anyone listening to this should totally double check me in case I'm wrong, but I think that's what they did. And so you both had a big asset class. It was an asset class that used to be run by the banks, but the banks are no longer able to make those kinds of loans. And it's an asset class that these people are motivated to pursue. With rising rates. And then, in private equity, you could earn everyone told you they were going to earn you a high teens, but in reality, they earned you a low teens, over a really long period of time. If here you can earn a 12, a 10, 11, 12, then it's like a really good trade for a lot less risk. And you could even put leverage on it on your side. So I think there's a lot of reasons. And is it a bubble? Which I guess would probably be your next question. Probably not. I mean, what people in tech used to say in 2014, 15, 16, 17, and 18 is like, how could it be a bubble if people keep calling it a bubble? Remember when Instagram got purchased for $1 billion, everyone called that a bubble. And when Dropbox went public, they called that a bubble. And, so I think here, credit's still priced probably on a relative basis better than equity. Equity prices really haven't come down as much as they probably should have based on where rates are, because everybody's pricing in that rates are going to come down. So, maybe if you're doing long dated credit, like equity is always implied long dated because you're underwriting into perpetuity, and credit's always implied short dated because you have a term. And so maybe both are priced correctly, but on a short duration basis, I think people should be in private credit. I just want to underwrite it to the next 20 to 30 years. So I don't know. I'll let you know in 10 years.
Got it. Ali, I mentioned David Rubenstein, and I wanted to talk about him one more time. He wrote a book called How to Invest, and I was very fortunate to have interviewed him based on what he wrote in that book. And one of the things that he mentioned,
I bought that book for my mom.
You got it? Oh, really? What does your mom think?
She likes it.
Yeah, cool.
Yeah, when I was playing baseball growing up, she always watched my games and kind of learned baseball through me. And now that I do investing, it's really sweet of her. She's reading investing books and starting to learn. And she'll send me an article from Bloomberg that says private credit is booming or something. So, she's
That's awesome.
Like I said, I've got very supportive parents.
Does your mom tell you that what he said about cutting edge investment strategy is what you're also doing? Did she tell you that you're doing esoteric credit, cutting edge investing?
No, she didn't mention that necessarily, but she was sweet and pretended like she enjoyed the fact that she was reading the book.
That's really cool. Cool story. Listen, I want to talk about how do you build a team within your organization? What kind of hiring decisions do you make? How do you make hiring decisions when you hire folks?
I guess the way I'll answer it is I'll talk about the things that we lean towards and some of the attributes we look for. We lean young because we think that the best firms have been built by young individuals who have grown organically in the organization. And we
Define
think it's
young.
easy.
Define young. I feel like I'm young. Do I fit into that young basket?
Cuspy. Um, we're looking for people where it's probably like their second or third job. That's our preference. Sometimes we need to make a senior hire because we have a new part of our business that requires it, or we really require somebody who already know how to do things. But what we're doing is we're trying to hire young people because we think there's sometimes negative selection bias in the people who are more senior in their professional careers that are willing to move. And if you think a lot about like the best executives at firms, and a lot of the firms that we look up to the most, they really grew their own talent. I mean, the average Apollo partner, I think, has been there for 18 years. Goldman was notorious for people being there for 20, 30 years of their career and making partner and really building a career there. And Goldman being part of their identity, especially pre-IPO Goldman. You think about people like John Gray and a lot of the legends that we look up to, at Blackstone and a lot of these firms. I mean, they've really grown their own talent. Sequoia, it's not an accident that, Doug Leone was really grown there. And, obviously Roloff had a big job at PayPal before going to Sequoia, but he became a venture capitalist there. And so that happens partly because, these people, they compound on their career so quickly because they learn how to do things, not just like how to do a private credit deal, but how to do a Coventure private credit deal. And what that ends up teaching them is where in the firm to go get stuff. How does the firm think? What risks do we like? What risks do we not like? What are the learnings that we've had collectively as a firm? And there creates like a style, that, and when you hire senior people, they have their own style. And it's not a better or worse style. It's just different. And often you kind of want that because you want to add diversity to your style and you want to learn from them and learn from the things that their firms have done. But you need to be careful about the right ratio of that. I mean, if you just have this like motley crew of 90 different styles that all kind of like get like squished together, it ends up being like a really weird dynamic. And so what we want is we want a core base of people who have grown within the firm, sprinkled in with a mix of other senior hires that have added their perspectives and helped us kind of see the things that we're doing wrong. And because of that, what we're really looking for is athleticism. That means that we're looking for like high horsepower, really good work ethic, high velocity. We're also looking for professionals. We kind of joke internally. I don't mind if someone goes to the Hamptons or goes to Europe for the summer or whatever. We just don't want it online. No need to put it on Instagram. We're looking for people who show up every day. They want to be professionals. They want to have quiet lives. We really don't like people who are flashy. I'm on podcasts and on the internet because it's good for the job, not because I have like any feeling of like needing people or wanting people to like an interview or something. I think we're looking for people who are technical. We much prefer when people have done banking or consulting before they join. I think it's like the new business school, except you get paid for it as opposed to paying for it. And we're looking for people who've been trained well. There's groups across finance that we think are really compelling. And some of the obvious groups that people think of are like SSG at Goldman, which is basically the PayPal mafia of credit. Anybody who's ever worked for Mike Dryden, who is at Sixth Street, is usually pretty compelling. I mean, there's some obvious and unobvious pools of talent that we love recruiting from. If you told me that somebody was at KKR or Blackstone or Apollo or wherever, I'd have a different opinion if you told me what group they were in. And so we have a point of view on where people have learned and done well. And we're looking for people who are obsessed with investing. I think the only way to work as hard as you need to work and to be really good at it is like you really have to love it. And it has to be the thing that you read about and talk about. And like, I often ask people who their friends are and what they do. And, what I'm looking for often is some diversity in friend group because I want to see people have different perspectives and stuff. But I'm looking for them to be friends with other really compelling, hardworking individuals. And I do want to hear that some of their friends do investing or work in some similar role, because I want them to like have that part of their social DNA. I don't really believe in work-life balance. I believe people really should obsess over the role and the job they have, because if you're really annoyed that you're working on a weekend, you're really going to hate working here. And so, we're looking for people with a lot of horsepower who just love the job.
So we're almost wrapping up here, but I want to talk about some other stuff than investing. I want to talk about you as a person. Let me ask you this. Do you believe in luck?
Yeah.
Can
Are you kidding?
can you share an
Luckiest guy on the
example of
planet.
when you got lucky? And yeah.
Yeah. Every time we have an investment that goes well, probably a lot of it was how much we worked on trying to make sure it would go well and mitigating the risks and all that kind of stuff. But yeah, I mean, things have to go right. Things have to break your way. The market has to develop. You have to have a lot of bad things not happen. You make a hire, you make an investment. You don't know how good management's going to be for a little while. So that's really lucky. Every time you walk into a restaurant, you get a good meal that you weren't expecting. It's a stroke of luck. You look at the restaurant, you look at how it looks, you read the reviews online, you look at the menu, and you don't really know how it's going to be until you eat there. That's the same as investing. We've made certain hires. We hired a woman named Elizabeth who we didn't really have a lot of social connectivity to in the beginning. And she came on as our COO, and she's just like a machine. I mean, unbelievable. The amount of leverage she gives our firm. And, we'll get reviews sometimes from people. And sometimes I just ask them what it's like to work with Elizabeth just for fun, because I already know what they're going to say. But it just like makes it like if I'm having a bad day, one of the ways to cheer myself up is ask a counterparty or one of our vendors or one of our LPs, like, hey, how's it been to work with Elizabeth? Just because I know it's going to be like a ridiculous compliment. And I just like need to hear some day. I mean, it's like the best party trick ever. I had one person write reviews on a bunch of people on our team, and they were all like 2 or 3 paragraphs, and hers was just like walks on water, period. So how good are we at hiring or interviewing? I mean, we're fine, but gosh, it's not that often that you come across somebody like that. And there's a number of people in the organization. I mean, Brian and I meeting in college was lucky. Isaac coming on and just completely revamping our finance team. There's Mike Brightstein, who we met because he was working on a deal that we saw him in that we never even got there on, but we got to see his work. And when he was deciding, so it's the hires that we've made. And if I keep talking, they start like naming too many people and leaving people out. But so many good hires we've made. We're an example of luck. Meeting Jarrett Waite, who is a Cornell alum, who just randomly introduced us to so many of his friends who became our first LPs. Meeting Mark Spilker, who just happened to want to do funky credit deals and was feeling good that day and gave us a big check, and then decided to spend. I mean, there's nothing I could do to make Mark's life, he's had a lot of success. I really hope I can just do something super impactful for him. But what he's done for us has really just been about like a connection and him being kind. And Savneet, speaking in one of my classes at Cornell, and then taking a bet on us and putting us on. I mean, he was the first believer. He introduced us to all the people who gave us money for the first Produce Pay SPV. Finding Produce Pay. So, oh man, the more success we have, the more we believe in luck.
What else do you want to share about Ali Hamed that we don't know about? I like the long pauses. Take your time.
We try really hard. We try really, really hard. And we don't always get it right, but we try really hard. We believe ourselves. And that's all we could do. I can't make myself any smarter. I can't make myself any luckier. I can't make myself any taller. But, we can try hard, and that's what we do. And I think most people who interact with us, they see that. And, I have a friend named Jesse Beirudi who has this awesome line, which is like the best way to keep promises is to not make that many. And, it's something that we're trying to learn because, everyone's tempted to overpromise, not because you think you're going to break your promises and you don't even think you're overpromising at the time. It's just you run out of time to make do. And I think we take our promises seriously and we work really, really hard to fulfill them, and we're kind of learning how to prioritize them. But yeah, I think almost everybody who's ever worked with us has felt like there's a lot of authenticity, a lot of sincerity. One of my best reference calls is somebody that we defaulted on, and that's pretty rare. Yeah, I don't know. We try our best. I'm not sure everyone does.
Well, Ali, this has been an absolute pleasure. Thank you for your time, and I'm sure we'll see and talk with each other many more years to come. Thank you again.
Awesome. Thank you so much for having me.
Absolutely. If you enjoyed this video, make sure to give it a like and also subscribe to the channel. And also below, you can comment. You can tell me what I can do to improve the content so I can continue to produce better content for you all. Thank you again for your participation. We really appreciate you.